reason why we're hosting this webinar tonight. Okay. September has been marked as a Life Insurance Awareness Month by Congress, and for that reason, we're taking it upon ourselves to educate individuals who may not know how powerful of a tool life insurance is. During this presentation today, you get to know about what life insurance is all about, how you can provide income protection, the concept of health and wealth, generational wealth building, tax advantage of life insurance, and business use of life insurance. Well, without further ado, I know we're all yearning to hear from him. It's my pleasure to introduce my friend, my brother and mentor, Bisi Ogunwale. Bisi, take it on.
Good evening, everybody. And I'm really excited to be here today. But I mean, something is happening here. I see Emmanuel Temenu in 4 places. Did you duplicate yourself in so many places, Emmanuel, or what's going on?
So I think what happened was the links I shared were mine. So that's what happened.
So, I mean, okay. That's interesting. You duplicated yourself. Nice. Anyway, welcome everybody to our Life Insurance Awareness Month webinar. As you must have known, September is Life Insurance Awareness Month. And we want to take the opportunity to talk about life insurance to everybody. All right? So please, let us talk a little bit about what life insurance can do for you and your family and how you can leverage it to be able to build, serious wealth for you. If there's anybody that you think should be joining this session that hasn't joined yet, please go and invite them. You don't want people to miss this session because this is going to be a life-changing opportunity for so many people who don't already understand how life insurance can help them. My name is Bisi Ogunwale, as my good friend and brother, Dr. Babatunde Aremu has already said. I work on the platform of World Financial Group and World System Builder, where we talk to people about personal finances. Our goal is to be able to help 30 million people to understand how to build solid financial foundation for themselves. Part of the campaign that we're doing with our 30 by 30 financial literacy campaign is to help people to understand how best they can take advantage of, instruments like this to be able to help themselves. So today, I'm joining you guys, and I want to be able to share with you how life insurance can help you and help each and every one of us to be able to build wealth, not only build it, distribute it, and also, transfer it to the next generation. Let me know if you see my screen. Nice. Okay, great. All right. So today we want to talk about money, wealth, and life insurance, how we can take our wealth building to the next level using, this particular instrument. Before I go, I'm going to start by saying the information that we're going to present inside this presentation should not be in any way interpreted as accounting, legal, or tax advice. It is not to offer to sell to anybody or to solicit anybody to buy any form of security, insurance, or any other financial product. This particular session that we're holding today is for educational purposes only. And we hope that, it will be able to bring some financial awareness and education to you. As a matter of fact, you will not learn everything that you need to know in this workshop webinar today. However, we know that you will learn a few things. You will gain some more confidence about the subject of life insurance and, health insurance, and you will have the opportunity to start thinking about how do you take action going into the future. And please, as much as possible, we want to beg you to please help us to preserve the context and the integrity of the information that we're going to share with you. So please do not take any sort of photos, recording of this particular session. And by that, I want to welcome each and every one of you here. Before I go forward, I want to say it again. If you know somebody that is supposed to be on this call that is not here yet, please invite them now so that they can join and so they will not miss so much. I want to first and foremost start with something that is important for us to talk about. If you look at US and Canada today, In North America, we look at income gaps over the last, 30 years, from 1991 to year 2021. And we find that 90% of people that are in North America, US and Canada to be specific, are controlling the minority of the wealth in the two countries, while only those who are in the top 10% are the ones that are controlling the wealth. How is it that the rich continue to grow rich while the average person continue to go poorer? It is by way of knowledge and information that makes this to be a little bit different. So today, I want to share with you that knowledge, that information that the top 10% has, that the lower 90% doesn't have. In our organization, World System Builder, we focus on how can we help people to build solid financial foundation. We want to help people to build solid financial foundation using this blueprint of having proper protection, being able to manage your debt, talk about emergency fund, and ultimately, how do we build investment into the future? So today, we're going to be focusing on the first layer of building a solid financial foundation, which is protection. Ideal situation is what we want to get to, but most of us, this is where our current situation is. What is protecting us today? The financial protection that many of us have is the income that we're able to make from the places where we work from. If you're not able to work, there is no form of any other financial protection. Heaven forbid that you get sick or die prematurely. What is going to happen to the loved ones that you have? If you get sick, how many years do you think your current employer can continue to pay you if you don't go to work? We want to help people to understand that it does not matter how much of debt you have today. If you come and work with us on this platform, we have some knowledge that you can use to get yourself to a better place when it comes to debt management. Because we earn income, we have monthly expenses that we need to take care of. We have to pay our mortgages or maybe pay rent, pay, utilities, food, clothes, shelter, and all of those kind of stuff. And then we talk about how do we begin to think about retirement, putting money aside for investment and all of that. It is also out of the income that we have that we're going to be able to do that from. But our organization is advocating that people should have at least 10 times the annual income that they have today as personal, protection, or protecting their family 10 times. We should work towards having zero debt, have at least 6 months of emergency, fund, which can cover our monthly expenses for the next 6 months, and ultimately build 20 times our annual income right now for us to be able to retire on when that time comes. Anywhere you see me mention Americans, I'm talking about both of us, in the US and those of, those in Canada as well. So I want to talk about American and human life concept. You see, a large portion of people living in North America today, they do financial risk planning in a very awkward manner. Most risk management and asset protection strategy focus more on protecting the golden eggs. Like you have auto insurance, you have home insurance, some people have rental insurance, some people have warranties on their telephone and their gadgets. But they forget to protect the golden goose that lays the egg itself, which is the human life. If you cannot work, you can't afford to buy that auto. If you cannot work, you can't afford to buy that mortgage. If you cannot work, how do you have that flat screen that you're protecting or that phone that you're buying warranty on? So if we purchase a brand new Mercedes-Benz today and the car was to get stolen or it was to be totaled in an accident, do you want to get a new Mercedes-Benz, like an economic value of that Mercedes-Benz replaced, or you want to have, any other type of automobile to replace it for you? Most times you want what you lost to be given back to you, right? So how does that work in this instance? Say you buy a property of $1 million today. Heaven forbid that it gets burned down. Would you want to be in a place where you have the $1 million worth of your property back, or you just want something else? So when we think about human lives, we need to begin to think about it in a different way. Why do we protect every other thing that is in our lives, but we don't take care of our own selves? We are getting far away from what we're supposed to be doing. And that's what we want to talk a little bit about today. Your greatest asset of all time is the life that you have and the health that comes with it. So how do we protect ourselves really well? Before I go and talk about insurance and all the things that we want to talk about with, this awareness, I want to talk about our human life and think about different timelines that we have. You see, the day you were giving birth to Thompson or Mr. Lawal or, Dr. Aremu, and the day I was giving birth to Eniola, we all came into this world. We were naked. We didn't bring anything with us. But it comes down to there's a day we're going to pass away. From the day we were giving birth to the day we're going to pass away, there's a dash of time in between that. What you put into that time is what will be the legacy of what you're going to be remembered for, Ms. Omaumi. But eventually, I want to talk about those different timelines in our life and begin to think about how can we situate ourselves in that space. Many of us are young parents today. Like myself, I have 2 children. I have a daughter who is 12 and I have a son who is 9 years old. A time will come in the future when these children need to go to school. Somebody has to pay for that. But in this part of the world today, in America and also in Canada, I see a lot of people going to school with student debt. When people get out of school, they begin to get jobs. They get paid. But a lot of people are not paid enough, or they are not well paid. So they get some pension. They don't understand it. Because we don't get paid, people are working from one paycheck to another paycheck. People need to augment. And then a lot of people are relying on their credit card. A lot of people are relying on their line of credit. People look at auto loan to be able to buy their vehicle that they will need to drive around. With that, there's also the fact that people need to get married and then begin to raise family. With family comes additional responsibility of food, clothing, shelter, and etc. People start to think of, oh, we need to buy our first property. And that comes with mortgages. Between student loan, auto loan, credit card, line of credit, and mortgages, debt has now become a way of life for so many of us who are living in this part of the world. And the challenge with that, my brothers and sisters, is the fact that we do this thing and we continue like that until we get to a point which we call the age of retirement. But you see, the thing here is this: what guarantees the fact that we're going to get to the age of retirement? What assurance do you have today, Tommy, that you will get to the age of retirement? What assurance do I have, BC, that I will get to this point? What if I pass prematurely before that time, Ola? What is going to happen to the people who are dependent on me? Because now I have a family. I got a wife. I have 2 children. I have siblings. I have a mom. All of these people are dependent on me. What's going to happen to them? So we talk about how do we protect ourselves so that, we can take care of our people even when we're not here anymore, Shakira. I don't pray for anybody to die young, but what if we get sick? And I'm going to ask you guys a question here. How many years do you think your employer will continue to pay your salary? Heaven forbids that you have a major critical illness today and you cannot work. How long more do you think they're going to keep paying you salary? Azizat, Dayo, Eniola, how long more do you think they're going to keep paying you salary for? If money is not coming anywhere because of medical condition and all of that, what then happens to us? How long can we maintain the same lifestyle that we have today if we're not making income from anywhere? You see, it's okay to die because once you're dead, you're gone, you don't know what is going on behind you. But if we're sick, we're here to live through the entire experience, and that's even a very dangerous one. So we want to talk to people about how do we take care of things for ourselves, like long-term care, critical illness, chronic illness, or terminal illness. I don't pray for anybody to die young or anybody to get sick. But if we don't die and we don't get sick, we're going to have to live. And I always pray, Toby, that we don't live too long. And people say, what do you mean by we don't live too long? I think the reason why I say I pray that we don't live too long, Bukola, is the fact that I'm saying if I live too long and I don't have enough money to take care of myself in old age, it's going to be a very miserable life, Mr. Francis. It's better to be dead than to live a miserable life. That's the reason why I say I pray we don't live too long. Because if we live more than the amount of money that we have, then what's going to happen to us, Fred? So where can we find income to take care of things for ourselves for the rest of our lives, as long as, we live? It doesn't matter whether we live a short life or a long life, whether we live a very good life or a, hard life because of medical condition. Every one of us is going to taste something called death at some point. And when we pass away, all the things that we have worked for in our lives come into something that is called estate process. If we don't have a proper plan for our estate, the government of the state and the country that you live in, Sambida, has a plan for you. And today, I want to talk to you about how our organization, World System Builder, will help people to understand what they're supposed to be doing with their personal finances. So we use financial education, help people to plan with proper financial knowledge. You see, so many people are taking crucial financial decisions right now without having the requisite financial knowledge to be able to deal with those things, and they're getting their hands burnt. So we want to help people to understand how can they do better with their personal finances. What if I die too soon or I become disabled? We talk to people about proper protection. We talk to people about debt management. If I pass away today, will my family be ejected from the house because we have, mortgage on that property? What if I have a business that has a business loan? What's going to happen to my business? I have 2 kids. How can they go to school? It's not that if they are going to go to school, that time is going to come eventually. If you don't do anything right now, it's still going to catch up with you. What if I want to be able to invest more? Or what if I want to be able to save more? What if I become incapacitated or I want to be able to transfer the things that I own? How much of taxes would I have to pay? These are the things that we talk to people about. This is what our financial education program is all about. We teach people every blessed day of the week, Mondays to Friday, 3 times in a day, 5 days in a week, and 52 weeks in a year. For the last 8 years, we have been talking about campaign for financial literacy, talking to people across US and Canada. Our goal is that we want to reach 30 million people with financial education by the time we get to the year 2030. And I hope that many of you guys can come and join on that campaign so that we can be able to help other people. So now I want to go into, the presentation of today. How do you begin to plan with the future in mind? You want to plan today, but you want to have a future in mind. I'm going to play video next. That video is a bit long. It's about 6 minutes, but it will lay the foundation for the conversation that we're going to have today. So please pay attention to this and please come along with me as you listen to, the legacy of love.
We don't tell the right stories. Or when we do, we tell them wrong. We focus on the wrong parts. Like there's a story we like to tell ourselves about life. In the story, we will grow up, go to college, have a career, get married, have a family, grow old, and when, after a very long life, it is time to get our affairs in order, life will let us know. As if death will be so kind as to warn us, he will inform us, like when at the end of a trip, a text arrives, an alert to our phone that says, say your goodbyes. Tend to your home, contact your lawyer, settle your affairs. Leave that story to be true until we are blindsided by heartbreak that seems so unfair. Beneath so much debt, it is a struggle just to get air. Everything was fine, and then out of nowhere, the phone rings. A siren wails. We crash straight into a doctor's chair. As the hair on our neck stands up, we stand up unprepared as she pulls the air from our lungs so we can't speak. We listen as she says the words, critical condition, terminal, hit and run. It's in his lungs. You are dying, and there is nothing to be done. And when we tell the story of life insurance, that's the story we tell. We focus on death, the tragedy, the sadness, but that's telling it wrong. And I'm not saying there isn't pain or heartache or sacrifice. Of course there is. That's life. I mean, those things happen for the same reasons tooth fairies and sunsets and great wine and grandchildren happen. And that's life. It's not that the tragedy isn't there. It's that it isn't all that's there. I mean, there's so much more. I mean, in all this hopelessness, hope is. But to see it, we have to shift our focus. Like standing in the middle of a burnt out forest, only we don't notice. Instead, we are drawn to where a perfect blue crocus lifts up its head to remind us that on the most tragic days, after we are dead and gone, life will find a way to go on. I mean, sometimes what happens in a moment stays with us for years, and yet the living must lift the head. Persevere. That is why at some point in the middle of all those tears, a laugh and a memory finds its way out. And when it is needed most, a check appears with a memo line that may as well read, despite the fact that my body is no longer here, I still am. My love lives. Even though I don't, my presence will be present. Even though my body won't. As sure as death is part of life, life is also part of death. So when your last exhale will wait no more, your loved ones will pick it up from the bottom of your lungs, place it lovingly onto their own, and complete your breath. The heart can stop beating, even as it refuses to. The body can stand tall, even as it is laid to rest, but it will only if you choose to ensure that a check will check on them on your behalf for years after you've left, because the answer is no. When the question is, are you interested in preparing for your death? But when the question is, do you want to take care of your family? The answer is always yes. If you ask my dad about dying, he will tell you he doesn't worry about his final resting place. He worries about my mother and paying the mortgage so she will finally have a place to rest without worry. My friend told me he had one thought as his son raced to the hospital at 3 a.m. with him in the back seat struggling to breathe. He thought, what will happen to my son if I die? I mean, that's life. He told me later. He said, that's how it works. Real love means it happens to you both. We don't buy car insurance for when we get hit. We buy it for when we hit someone. We don't buy life insurance for when we die. We buy it for when they don't. We buy it because when we love someone, we want to protect them from any added despair, any hardships that can be spared, to experience the happiest moments, even when we won't be able to experience them beside them. And it gives us comfort to know if we aren't able to have those moments, we can provide them. I mean, moments like walking down the aisle, right? Or the first grandchild born, moving into your new dorm, eating together as a family, hanging pictures on the wall of your first home. In all of those moments, Dad is here, Mom is with us, Ethan lives. It is because of Susan this was possible. In all of those moments, we are none of us alone. This is not about memories, but what our lives are able to become. This is about understanding that when you love someone, you do whatever you can to help them, to hold them, to enfold them in the truth of this immutable fact. Life insurance is the final loving act of a person who at the end didn't see flashes of his own life. Instead, he saw the future he wanted for his parents, his kids, his wife, and he knew that if their pain could somehow be lessened, their load perpetually lightened, then perhaps their grief will be less sharp than it might have been. And by preparing for what might be, despite being frightened, it's like taking your loved one softly by the wrist, holding out the life insurance as a gift and saying, This is for all the flowers I would have bought. These are pennies for all of our children's thoughts, the mortgage for the house we finally got. I don't know if it's enough, babe, but it's a lot. Please use it to make the life we dreamed about exist. And if our kids ever wonder if I love them, you give them each a kiss while clenching this life insurance policy in your fist, and you tell them there is no doubt he loved us. He did this.
Every time I listen to this video, I watch this video, it just gives me chill every time. It is not about when we hit, we don't buy life insurance because we're going to die. It's because the people that we care about will continue to live. It's a matter of responsibility, obligation, your duty to the people that you genuinely care about. So I want to quickly look at across North America, both in the US and Canada. These are all the different types of life insurance policies that you can find. And it does not matter which one you buy. What is important is the life insurance that you have the day you need it the most, or the people that you care about the most needs it. That is the life insurance that makes the most sense. It doesn't matter whether it's a term insurance, whole life insurance, or universal life insurance, whether it's a variable or index universal with long-term care. It does not matter which one you have. What is most important is you have one that is available and useful on the day that it is needed. So I want to talk about different ways that life insurance can serve people. The first one that most of us are aware of is, if I die, somebody is going to collect the death benefit. There's nothing wrong in somebody collecting the death benefit, because the truth of the matter is whoever collects the death benefit was somebody that you were financially responsible for. So let's look at options of how we've helped people with life insurance with death benefit. You see, a couple of, just like less than, about 14 months ago, For 2 years consecutively, we kept going after this gentleman. We want you to write a life insurance policy because you have 3 children and a wife. You guys just got a mortgage. You need to protect your family and protect your household. Please, can you unmute? I mean, can you mute everybody today? There's noise coming from somewhere. Okay. And guess what? For over 2 years, we kept going back to this person. I kept saying, you know what, guy, you got to do this thing. Grudgingly, in June of 2022, we set up this life insurance June 9th, 2022. Guess what? In December of 2022, just 6 months after this guy took out this life insurance, death came, and then he passed away on December 13, 2022. And how much has he put into the entire life insurance when he did this? Just $1,200. After he passed away, it was a long way of looking at, you know, the claim process, because the gentleman passed away back home in Nigeria, and then the insurance company needed to push people out to Nigeria to go and investigate the entire process. The investigation was concluded, and in July, we got the first word that, yes, we're going to pay the benefit. $700,000 was paid to his wife and his 3 children on August 11, 2023. This past month, we handed over the check to them. It's never given me so much joy that I could see how we can help this family, a widow, and add 3 children into the future. This is another policy that we delivered, you know, death benefit on in March of this year. $1.6 million was given to this family because of, you know, the man had gone to work in the morning and was coming back from work in the evening, and an 18-wheeler truck ran into him, and then he passed away immediately in that accident. A couple of months later, this happened in January, by the way, it was winter, and then we got this paid to his wife and his 3 children afterwards. That is about death benefit. We don't know when. Every one of us is going to pass. When, we don't know. Well, let's talk a little bit about, you know, what if, you know, you can think about, if I get sick, if I have a critical illness, what is your plan? If you get into an accident, let's say that gentleman didn't pass away in the accident, but he became disabled as a result of that particular accident. What is the plan? What if something happens to you and you cannot earn income the way you used to earn income? What's going to happen to your family? Who's going to take care of you? Who's going to be responsible for all the duties and the obligations that you have? In North America today, specifically in America, Center for Disease Control, they look at the reason why people have leading causes of death and disability today is 1, heart disease, cancer, lung disease, stroke. We have Alzheimer's, diabetes, and chronic, you know, kidney disease. This is the major reason why most people, you know, are having serious medical situation now. But think about this. This population says 6 out of every 10 is going to have one chronic disease before the age of 65. 6 out of every 10. We're 67 of us here. If I use that statistics, you know what that means for us? Out of every 10 of us, 6 of us is going to have one of these conditions. Out of every 10, 4 out of every 10 will have 2 or more. What are we going to do if something like this were to happen to us? Guys, I want us to pay a little bit attention to this. I was researching about, you know, bankruptcy, and I found something that was put online by the American Journal of Public Health. They said the reason why people declare bankruptcy the most in North America today is what? Because of medical issues. Medical issue is the reason why most people declare bankruptcy. You know why? People can't work, but the bills don't stop. It keeps going and all of that. So let's keep moving forward. I want to talk a little bit about how can we help people, and I'll show you what we've done to be able to help people to protect themselves. Think about this situation. There's a 40-year-old person who decided, you know what, I want to buy a term life insurance with living benefit. This lady, an hypothetical situation, by the way, because we don't want to put people's name, $250,000, bought that at the age of 40. At 48, she had an attack, but she didn't die. She needed money to be able to take care of herself. Out of the living benefit that is on that particular life insurance, she was paid $124,799 to be able to take care of things for herself. There's another situation. The gentleman's name is called Michael. This guy had bought a 15-year living benefit term insurance, $1 million, saying, okay, I want to be protected to the point when I get to retirement. But you know what happened? He was involved in an accident and he needed, money. There was a big injury and it was during that accident. Of that $1 million, accelerated death benefit that was paid to him was $559,000 to be able to take care of things. I want to show you another check that we were able to give to somebody in the month of May this year because of terminal illness. This person bought an insurance that has this kind of rider, on it. And the family and that person got $242,972.63 so that they can be able to take care of things for themselves. I was in Maryland just about, 3 weeks ago. And then, I was chatting with a group of people when somebody called Angela was introduced to me. And, she asked, what do? I mentioned it. So, oh, wow. I just want to say thank you for the work that you do. I said, why do you say that? He said, because of somebody like you who walked into our house and my aunt decided to buy life insurance 4 years ago. Today, we are very thankful because she just passed away 3 weeks ago. But we were able to give her, the experience during her final days while she was passing through whatever she was passing through. Because what? They got that rider of terminal illness paid to them, and then they were able to use it to take care of, so many experiences for them. You see, I've talked about what if I get sick? What if I die? I want to talk about how life insurance can help you to build wealth. And that's what I'm going to be focusing on for the remaining, part of this exercise. So let's go, my people. In America or Canada today, where do people put their money? Where do people put their money? You want to save money, people put their money in the banks. People want to be able to save money or say, oh no, I'm going to invest in real estate. I'm going to show you how life insurance can be a very, very good instrument for you to be able to put your money into the future. There's this book that is called Money, Wealth, Life Insurance that was written by a gentleman known as Jake Thompson. Jake Thompson wrote this book in the year 2013. And he talked about how the wealthy are using life insurance to be able to have something that we call a tax-free personal bank. And in that book, I took out an excerpt. That excerpt says, cash value life insurance plays a massive role in financial institutions, corporations, banks, more than you could ever imagine. These organizations buy life insurance by the billions, and they use it for many different reasons. Not only does it increase their financial stability, it reduces their taxes. It is an ideal place to fund employees' pension, healthcare costs, and other benefits, to the point that it has a name that has been given to it. When a bank owns it, it is called bank-owned life insurance, BOLI. And when a corporation owns it, it's called COLI. Let's talk a little bit about some major banks in America today. Bank of America has life insurance asset of about $20 billion when this book was written, some 10 years ago. Wells Fargo, about $18 billion. JP Morgan Chase, US Bank. And there are some other corporate organizations like General Electric. I'm going to talk a little bit about how General Electric is even using life insurance a little bit, into my presentation. Walt Disney, Starbucks, Avon, Verizon, Nike. Think about Pfizer, Johnson & Johnson, and so many other organizations who have used life insurance. But before I go into the organization, let me show you what these banks that you see them here, let me show you where they are. This is the balance sheet of Wells Fargo, Bank of America, and Morgan Chase Bank as at last year, the last balance sheet before this recent, financial year end that they have in 2023. This is at March 31st, year 2022. The life insurance asset that is on Wells Fargo's balance sheet today is about $20 billion. The one for Bank of America has grown to over $24 billion. US Bank, JP has over $12 billion. So if you're still thinking about what is going on, I'm going to show you the reason why the banks put their money in life insurance assets. A tier 1 capital is what is the reason why the banks put their money there. The core capital of a bank, cash surrender value of a BOLI, is classified on the balance sheet. It is an integral component of the tier 1 capital for most banks. What is that? It is very, very important component of any bank. How did I know this? In 2008, I was doing my MBA back then in the United Kingdom, where I went back to, to take an MBA in finance. And I would never forget this. I just landed at Heathrow. I was coming from an interview with a bank, in South Africa. And I just walked out of the plane and got into the terminal. And the first thing on the, on the screen was Lehman Brothers has fallen. There, as a finance person, I understood 100% what that meant. Over the next couple of days, there will be inquisitions in the Congress, and so many CEOs of several banks were invited. And that was the first time ever when they asked them, where is your tier 1 capital? Most of the CEOs kept mentioning different insurance companies that they have their tier 1, capital with. And I was just wondering, oh, wow, oh, wow, oh, wow. Tier 1 capital is a very core capital of all banks. The bank's foundation, the structural steel on which they built everything. The larger the tier 1 capital, the stronger that bank is going to be. A primary purpose of this capital is to be able to cushion the bank in the time of adversity so that they can use it to support their balance sheet. A strong tier 1 is that the banks is what every bank strives for, because that is their lifeblood, right? So let's talk a little bit about other corporations. What are they doing? I'll show you. Think about this. General Electric, Procter & Gamble, AT&T. Who remembers Johnson & Johnson? Who remembers Pfizer? You know how much money they made in the last 3 years with, COVID? Think about CVS. Think about Verizon. Think about Walt Disney. Let's talk about how different organizations have used life insurance over the years to be able to build wealth for themselves. There's an organization in America that is called JCPenney. JCPenney went into serious trouble during, the World War II and the Great Depression. They almost closed down. But what did, JC himself did? JC decided that he wanted to be able to keep his business going. In his, in his biography after he passed away, they wrote there that he borrowed money on his $3 million life insurance so that he can be able to keep his venture going. And that's where, JCPenney is today. That organization is a multi-billion-dollar empire today. Another organization that we all know is Walt Disney. Everybody wants to go to Wonderland. When Walt Disney wanted to start the Disneyland, Disneyland in Anaheim in the 50s, every of the financiers that he went to says they cannot lend money to him. Why? Because they thought it was too leveraged. But this man believed so much in his dream, and he was looking for how to take care of things for himself. He sold most of his assets. He recruited the help of so many people. But the most important asset that puts the final nail on the coffin of what, the Anaheim Disneyland is today is that the man took a loan from his life insurance policy to be able to start what is now known as Walt Disney Incorporated. Walt used money from his life insurance loan to fund the feasibility study that started that particular place that is now known as Disneyland today. Guess what? If you knew that this was going to be the situation, would you put money into this and fund something significant for yourself? There's another farm that is called Foster Farm. In 1939, Marx and Werder, they wanted to be able to take care of growing their farm and making it something that is formidable. They had to borrow money from their life insurance policy to invest in an 80-acre farm in California so they can be able to raise chicken and turkey. And today, Foster Farm is one of the largest, organizations out there, selling products across the entire of the world with over 10,000 employees. How many of us once or dreamt to go to Stanford University or want our children to go to Stanford University? When I was reading the story of Stanford University, I found that also there was life insurance involved in the process. Leland and Jane Stanford, they lost their child to typhoid fever. And so they decided they wanted to do something, start a research institute so that they can be able to help other people's children. And that was how they started, Stanford University. But that university would run into trouble when the gentleman Leland passed away. Leland Sr., by the way. And the only way Jane could keep the university going was to use the life insurance proceeds to help to fund the operation and pay all the faculties so that they can be able to pass through those 6 dangerous years of financial distress that university has today. I mean, at that time, look at where Stanford University is right now. So if you're a business owner here today and you're thinking, how can I use, life insurance? I want to show you a little bit about how life insurance can help business owners. Most business owners don't have any employer that is giving them, fund for either 401k or RRSP or putting money away into, any place towards defined benefit or something like that. You can help yourself to start thinking about how can you use life insurance to be able to plan your retirement. If you have any major employee that you know that is going to leave and your business will be severely affected, you can use a life insurance to talk about key employee, protection. You are thinking about, what's going to happen to me and my family, my business, if I were to pass away? Or if I just don't want to do this again, I want to move on. You can use life insurance to do business, succession. I know you think about taxes a lot because we pay so much. How about thinking about how you can use life insurance to reduce the amount of taxes that you're going to pay? For example, you can do what we call a buy-sell agreement, which makes for an excellent exit strategy in a business planning situation. When 2 partners decide, we want to do something, if a partner decides that he wants to leave the company, or the partner were to pass away, or they become disabled, all the insurance company is thinking about how can we compensate a retiring or somebody who is, in the business. You can use life insurance to be able to take care of all of these things that I mentioned. In case of death, most attorneys are looking at how do we pass on the things that people have worked for to their, to their heirs. You can use life insurance to do that. For example, if you're in partnership with somebody and your partner were to pass away, do you want to have the spouse of that person come into the business? What if they don't have any business experience? You can use a life insurance to be able to take care of things there. You can do so many things. It does not matter whether you're a large or a small corporation or anything like that. If you're thinking about how you want to reduce taxes, life insurance is a good opportunity. Think about working capital for your business. You can take advantage of so many things. For example, when you are setting money aside for use on a short-term basis, people put it mostly in, savings account. It provides you liquidity, don't get me wrong, when you need it, but you're not earning enough money on it. But if you put it in a life insurance that gives you higher return and then provides you that same liquidity, it takes care of so many things for you. I know of a story that I read in one of my, role models book. It talked about a guy called Bobby Collins. And I've listened to Bobby personally myself too before in one of the webinars that, Doug Andrew did. It says this guy bought life insurance with cash value, first and foremost to be able to protect himself and his wife, but they also use it for business opportunity. They have cash inside that particular life insurance. And there were a lot of contractors, people who wants to do flipping of property. They will buy, next to nothing property. They want to do facelift. They want to, force the value of it by just doing some renovation and then put it back on the market. These guys are looking for quick money to be able to do that. What Bobby was doing was lending money to these contractors at a very interesting, interest rate, but he was using money from his life insurance policy, serving as a bank to them to be able to fund them. There's so many things you can do with life insurance if you understand how it works. What about real estate? I want to talk a little bit about how, life insurance and real estate compares. And I'll talk about 2 different, scenarios. But think about this. There's a gentleman called Dan Blanton. He's the president of Money Tracks, and he talked in one of his books about the benefit of having cash value than to have, home equity value. And this guy was referring to Hurricane Katrina. Let's not even talking about Hurricane Katrina. Look at what happened in Hawaii with Maui, the fire. Look at what happened in Edmonton. Look at what happened in different places with serious fire, tornadoes, and different natural disaster that has wiped out a lot of wealth for so many people who have properties. This guy said, I could never have anticipated the impact of Hurricane Katrina. We have been in the path of a hurricane for many times, but never dreamt a hurricane could change our lives forever. I believe in the conviction of cash value is more valuable than home equity. And I've preached that message for over 12 years now. I have encouraged my clients over the year that having their home paid for is a desired position, but doing so in a way that gives us liquidity, use and control may not be the best way for them to reach their financial goal. It says his personal opinion is that when you have to write the check, when you have cash value equal to your mortgage balance, your home is paid off. Having the money to write the check if you desire is most comforting. It is not necessary to have your home paid off. You need the cash. What happened in this instance? Many people paid off their homes and they were sitting down on equity. Last night, one of my friends reminded me, BC, many of us think we have wealth. You don't have cash, you just have paper wealth. Because if something happens to those real estate that you're sitting down on today, you don't have any wealth at all. So hurricane came and destroyed everything. Many people lost their homes. Everything that they have was gone with it. It says those who had paid off their home are in a rough time, working with insurance company and talking to attorneys, trying to get back to square one. Property value most likely will not go back to pre-hurricane value, even when the homes have been replaced. In any case, it is going to take years. They had no mortgage, but now they have no money and they have no job either. The entire equity in the hands of the hands of the insurance adjusters. Many have been offered check much more less than what the property was worth and even to rebuild. Many have taken the own money today in an effort to move on with their lives, even at a loss. But those clients who have cash value in their life insurance have much different reaction to their tragedy. Their mortgage company has frozen their payment due and even gave them, payment holiday for the first year on the homes in the area. Even on the homes that were not even affected. Meanwhile, because they had cash value, they had secured another loan to be able to buy new property and put down, money from the cash value that they have. So they put down payment on a new home and then were able to settle down and keep moving forward. This has provided seamless opportunity to get their families and their jobs back on track. He now said, I'm convinced now than the day I got into an insurance business. Insurance is the greatest product ever invented, and cash value is much more valuable than home equity value. What if you want to plan retirement? How does that work with life insurance? I was reading through, different financial journals, and I saw this particular article about a football coach that is named Jim Harbaugh. In 2016, they mentioned in this particular, I think I saw this firstly in Forbes magazine. It says cash value life insurance makes college coach, Harbaugh, football's coach, third paid person in terms of football coach in the entire country. In August, the University of Michigan announced that it had now amended its contract with head football coach Jim Harbaugh to include what is called a creative deferred compensation alternative involving cash value life insurance. The arrangement makes Harbaugh the highest paid college football coach in the country, according to Sport Illustrated and other news outlets. What most people do not know, this is where I want you to pay attention, however, is that the compensation strategy was designed to provide Harbaugh with millions of dollars of tax-free cash during retirement. It is one that can also be incredibly effective on a much smaller scale. So, Mr. Lawal, Mr. Kester, Mr. Thomas, there's nothing that says that you cannot design your own retirement plan, as this goes. Shirley Jackson. Now, I want to show you a corporate organization in America today, one of those giant organizations in America, how they pay their corporate executives. How many people here knows General Electric? General Electric is one of the biggest companies in the world. And I show them as one of those who are taking advantage of life insurance a lot. But they don't only take it for corporate, they also use it for some of their corporate executives. And you see, there's something that I like about, executive compensation. It's very discriminatory. Unlike, workers' benefit that is not discriminatory. You can decide how much compensation you want to give anybody based on whatever it is that you want to do, as long as it's an executive compensation. Now, let me show you what these guys did. They want to pay their corporate executive, Ola. Instead of putting the money in a retirement savings account, you know what they put the money? They put in a life insurance for them. You know why? Because they know that there is going to be a call for taxes on their retirement savings, Shirley. And what they did was to put the money in a life insurance policy because they don't pay any form of taxes on that. Now, think about this. What type of life insurance are they talking about? They said taxable payment to cover premiums for universal life insurance policy that is owned by an individual, executive. This policy include one, executive life that provides universal life insurance policy for the named executive, totaling $3 million in coverage at the time of enrollment, and it can be increased 4% annually thereafter. They put 2 times their annual salary, which is annual pay, which is salary plus most recent bonus in the policy. Can I ask you a question? Do you know anybody that works with GE Electric? Can you ask them, do you get paid this way? The answer is no. I have 3 of my friends who are vice presidents in General Electric. Every time I show my guys this particular slide, they're always like, what? Do you know the reason why these guys could do what they do? Why? Because the government gives them the opportunity to be able to do it, and they take full advantage of it. Why do they take advantage of it? It is because of taxes. And that is where I'm going to concentrate my presentation for the next couple of slides that I have. Let's talk a little bit about taxes. For my Canadian friends, you do know that Canada is one of the most taxed countries in the world. To be honest with you, Canada is the second highest in terms of taxes that is being paid, behind France. France's highest tax today is 54.5%. Canada is 53.5%. If you earn $1 million as an employee in Canada today, your take home will be less than, it will be around $486,000 out of that $1 million. Let me say it again. If you are an employee of an organization and you earn about $1 million in Canada today, you will go home with just about $486,000. Let me show you the history of taxes in America. Federal taxes, by the way. Over 100 years of taxes in the United States of America. There was a time, if I told you that there was a time in the history of America, that people were literally working for the government. People paid about 94% of what they earned to the government as taxes. Would you believe me? It happened. I don't know if it can happen again, but it has happened before. So, if you think about this. When was this? World War II and Great Depression era. And that was when stuff like 401k, stuff like RRSP in Canada started, because a lot of people were thinking about, why do I have to pay taxes on everything? Why should I take my money anywhere? So the government started this project so that people can put money there. They needed money for a long time to be able to rebuild and take care of the economy, with the hope that in the future, when you need the money, you will pay less taxes. How does your money get taxed? For my Canadian friends, this is more, you have some more of US assets on this slide, but I will explain with both countries. If you put your money in a savings account in the bank, or you put it in GIC or CDs, which is certificate of deposit, or you buy stocks, or you put your money in mutual funds, those will be taxed with something that we call capital gain taxes. If you put your money in, 401k, which is the same thing as IRSP, or you put your money in IRA, you put your money in different annuities like CPP and all those different types of pension plans, my dear sisters and brothers, it will be taxed at whatever your income tax rate is. 100% of all the money that is in there will be taxed. But there are some accounts like Roth IRA, TFSA, like municipal bonds, like 529 plans or RESP, like 7702 plan or life insurance plan that they have tax advantages that they don't pay any form of taxes on them. And that brings me to show you how those plans kind of work. Because we're talking about life insurance, we're going to focus on the life insurance part of that particular stuff. If you have a cash value life insurance, how does this work? I'm going to show you 3 different hypothetical scenarios of how somebody can use life insurance to plan for the future when they are thinking about how much taxes they're going to pay. This is an hypothetical situation, by the way. This person decides that I'm looking for an opportunity to be able to have $300,000 when I get into retirement, but I need to invest and put money aside from today. Depending on what that person used to put the money away, these scenarios are what are going to happen when that time comes. If you're going to take that $300,000 from an asset that is 100% taxable, like your RRSP, like your 401k, like your CPP, like your IRA, like your annuity, like your pension plans, if you are going to pull out $300K from that, this is based on the US market in terms of the taxes that we use to calculate this. Of that $300,000, only $213,000 will get to you, Ms. Jackson, if you were to be this person. This person will pay about 29% of his or her money in taxes. And this is based on taxes on your state, Falakemi, and the federal taxes. What if the person has an opportunity to understand how taxes work? Before putting the money away, the person decides to diversify the investment into different places so that they can have access to the money from different places going into the future. What would happen in that instance? $100,000 in one bucket, another one, and then in the third bucket. The first bucket, the person will pay state and federal taxes. The second one, the person pays state and federal taxes. But the third one, they don't pay any form of state or no federal taxes. Because of that understanding of how taxes work and how it affects us into the future, this person diversify, and then now that diversification helps the person to be able to have almost half the effective tax that he or she is going to pay. Extra $40,000 in that person's pocket after paying taxes. Do you know what extra $40,000 will give you? That is extra $3,200 on a monthly basis per year. What do you think you can do with extra $3,200 that you don't have to pay any form of taxes on? Just by having an understanding of how taxes work. A lot of people in the last couple of years that I've been in this business have called me, BC, if I don't have to pay taxes in that bucket, why don't I just put all my money there and I just know that I'm not going to pay any form of taxes? What we're trying to tell you here is this. We're not telling you that you can 100% avoid paying taxes. You know that tax evasion itself is an offense. Tax avoidance is allowed by the government. But what we're trying to do here is not for you to say, oh, you're not going to pay any form of taxes. But we want you to avoid 100% the ones that you don't have to pay. How do you optimize your investment and minimize the taxes that you're going to pay is what we're talking about in this part. There's one more scenario I'm going to show you. If you know that there's a place where you can maximize, your investment without paying taxes, what if you can, concentrate more of your asset into that place? So this person thinks about, oh, what if I skew or I weigh more of my asset to the place where I don't have to pay taxes? And then I want to now access my money in the future. Of that $300,000 that is available for that person to use, only about 6.1% of that is paid in taxes. Now, compared with the person that uses a retirement or all taxable account, this person has about extra $80,000 in his pocket beyond the first person. Do you know how much money $80,000 is? That's extra $7,000 every blessed month. And that changes, the entire dynamics of how people can be able to live better in their retirement. So today, I want to show you the 3 scenarios. The first scenario is when the person put all their eggs in the place where everything that they work for or their life is taxable. The second scenario is where they diversify into different places. And then the last scenario is they diversify, but more concentration in places where they don't have to pay so much of taxes, or they don't even pay any form of taxes at all. And that shows you how this person can use life insurance in this instance to be able to reduce, their taxes. Many people in North America today, US and Canada, do not understand that life insurance is a tax-efficient vehicle that you can be able to add to your portfolio and begin to build a better portfolio for yourself. So I want to ask you, ladies and gentlemen, can you consider having this investment product added to your financial portfolio? A cash value life insurance can provide you with 3 major benefits. Number 1, tax-free death benefit to your loved ones in the event that the person were to pass away prematurely. There is tax-deferred growth on your investment. You don't have to pay taxes on an annual basis like in the first scenario. And then you can now use what we call tax-free income potential, when you need the money. I'm going to show you some of the statements of our clients to also show you how this investment is working. This client is somebody, that I know personally and I've worked with for the last couple of years. When this policy was set up in 2015, that policy was set up for $1 million. And that person was a 45-year-old person at that time. 8 years down the line, I want to show you the statement of this person for the last 2 years. What this person decided to do is, at the beginning of this person's policy, they maximally fund the policy so that they can push money into it and then let it generate significant amount of, money for them into the future. What does this person do? In the first, 7 years of accumulation, they put a significant amount of money into it. The balance of the beginning of 2020, at the beginning of 2021, May 26, 2021, which is the end of the previous financial year, this person had $236,000 of cash in their cash value life insurance. So in addition to their $1 million life insurance, you can see that the gross death benefit is at $1.25 million, 303. How much premium did this person pay in year 2021 leading into 2022? They didn't put so much into it. They only put $1,012.04. How much is the interest that was credited into the account? This is $29,857.47. Why is this person able to get this much? Because they front load the life insurance, they use it as an investment, and they put a significant amount of money at the beginning. Imagine that you don't have to pay any form of premium again. Just, this is less than $100 in a month. $1,000 was what the person put in that year. And they still got interest of $29,857. Then there was the normal deduction out of it because cost of insurance and investment and all of that. But this person's portfolio grew to $259,303. And that $259,000 is the opening balance of the year 2022 to the current year that we're in, year 2023. Now, we all know that the market was really very shitty last year. Very, very crazy market, right? But what happened in this instance? This person had $259,000. They didn't even put any premium, as you can see. No premium paid. It's just $15.27 premium that went into the account. But still, because the market was really very mad, they still got some interest of about $2,063. With all the charges and all of that that went out of the account, the ending balance of this person's portfolio was still $253,753. That is the beginning of this financial year. I hope that I live to 2024. We will be able to show some of you guys, what this particular account is doing when that time comes. What does this tell me? This person needs money. They can always come and take money out of this. Out of their life insurance, the money is still there. Let's talk a little bit about how you can use life insurance for your children. I want to talk about $1 Million Baby Strategy. For our friends in the US, our friends in Canada, you can set up your children for the future. I just finished speaking to one of my younger, quote unquote area brothers whose, wife just gave birth to a baby girl. And he said to me, I want us to talk about all the monetary gift that they gave to my child when we did the naming ceremony. I want to set up a life insurance. I want to put that as a deposit down. Let's illustrate something that we can use to be putting money aside. And I did an illustration. Look at this. This person puts $1,000 into the policy starting today and decide, you know what, I want to be able to put $400 on a monthly basis into this policy. How much growth can we envisage? At 7% illustration, just looking at, that is an average that we think we can get. This person keep putting the first year, $5,800, but going for $400 every month. By the age of 15, the total amount is $73,000. We stop putting money into this at age 18. At age 18, the total amount that has been put into that account will be $87,400, and they don't have to touch it again. By the time that child turns to age 25, there will be at least $192,315 projected, into the future for that particular child. But that's not the point. The point of how this can build wealth for this child into the future is what I want us to look at. Still the same amount, no additional money added to it. When this child gets to the age of 50, how much cash value do you think will be in that life insurance? Projected at 7%, $830,000 or thereabout is what will be in that account. How long before this child becomes a millionaire? That child can have at least $1 million in his life insurance or a life insurance policy if they don't take money out of that account by the time the child gets to the age of 54, because of what the parent did for the first 18 years of that particular baby's life. That child will have over $2 million in his life insurance policy or life insurance policy by the age of retirement at 65. Compound interest is something that you don't want to play with. If you understand how it works, you're going to change your life. Now, I want to talk about a strategy that I see in America that works for a lot of people, which is called a new financial solution. I call that index strategy. My friends in Canada, I'm sorry, there's no index strategy in Canada yet. I know a few organizations are working on that strategy, but it's not in the market yet. But there's index strategy in the market in the US. What does index strategy mean? I'm going to explain it to you with the next couple of, stuff on this slide. People want to save their money. A lot of people take the money to the bank. Remember what I said, you take the money to the bank, the bank take the money to go and put money in insurance companies. But if you put your money in the bank, it's because you believe that the bank is a safe place for you to put your money and nothing is going to happen to your money there. There's safety, but you have inflation risk because you don't get too much of interest. The interest is not, that great. In fact, it is shitty, actually. Pardon my language. A lot of people get angry and say, oh, the bank is ripping me off. I would go and invest my money in the capital market, which is a very wise thing to do. But if you go and invest your money in the capital market, what that means is that you have access to be able to gain good return when the market does well. But if the market does badly too, you are open to that market risk due to volatility. So there is no certainty. Some people will be having palpitation when things like this happen. Let's say you put the same $100 there and the market went down by 20%, just like we saw with S&P 500 last year. That market lost 19.98. So if I look at 20% market down with S&P, it means that if I had put $1 million in that market, at the end of the year, I would have lost $200,000 out of my money. So market goes down. Let's say market comes back by 10%, comes down again by another 10%. That 20% new gain does not compensate for the 20% loss that I have. It will take another 3 to 4 years before I can get back to where I started, before I now begin to go to, where I want to go to. What is the assurance that the market is not going to crash again in another 1 or 2 years or 3 years from today? But if you have what we call an index strategy, it is a combination of things from both sides. You can find safety because index strategy tells you that you will never lose money regardless of whatever is going on in the market. And you can also find market return because index strategy tells you that you will not share the down, but you would share part of the upward. So if you think about, oh, I want to be able to save money into the future. I don't know about you guys, but if you go and look at something with your 401k account over the last 3 years, you will see how the thing has just been dancing up and down and all of that. What if you can put your investment for retirement in an annuity that gives you the opportunity of indexing, that anytime money goes down, the market goes down, you don't partake in the downside, you can always have upward situation. Or you put your money in a life insurance policy that gives you only the upward gain, not the down part. It is only with an insurance company that you can find an index strategy. You cannot find it with any other financial institution. Whether you want to do annuity or you want to do, an index universal life insurance. Those are the only two products that can give you, indexing strategy. So what if I put the same $100? If market lost 20%, instead of me to lose money with the market, you have an opportunity to either be at 0 or you get a maximum of the 0.75, depending on what strategy that you run that index universal life with, or your index, annuity with. If the market gains 10%, I gain 10%. If the market gains another 10%, I gain another 10%. I don't need to ask you, of these 3 different strategies, if I were to ask you, Ms. Jackson, where do you want to be? If I ask you today, Denise Adeniji, where do you want to be? Ms. Watson, where do you want to be? Abunimana, if you are the person that is doing this, you have the chance to have a market-based return without the risk of you losing your money. If you have an opportunity like that, what do you think your financial future will look like? So as I close here today, I want to talk to you about how you begin to see how this helps you to put things in different perspective of how to build wealth. Because in building wealth, there are different 3 strategies. The first part of it is I want to build wealth so that by the time I get to my old age, when I cannot work as much as what I do right now, I want to be able to find something that I can retire on, that can I rely on to be able to take care of myself. One story that I forgot to tell you, or that I didn't say earlier, in terms of, accumulation and distribution, was when the market crashed in 2008, because of all those, Freddie Mac and then the mortgage crisis that we had in America that year. I was schooling in the UK at that time. And just like I said to you, I just arrived from Joburg from an interview, but I used to work as an intern on London Stock Exchange with one of the firms that was a boutique investment and asset management company. We had this woman, her name was Shirley, and Shirley had an investment portfolio with the organization that I used to work with. She was 63, and she was hoping, oh, I'm closer to retirement. You guys have built this thing. But at that time, it wasn't an index strategy. It was a variable strategy that the person was running. Market lost about 40%. That woman's entire portfolio was wiped off by almost 40%. Because of that singular volatility of the market in 2008, 2009, she had to work extra 10 years for her to be able to retire. She wanted to retire at 67, but she didn't get to retire until she was about 75, 76 years old. Why? Because the money that she was relying on was not there. So it's not only about accumulation that you have to worry about. You also need to have the assurance that when you want to use the money will be there, because that distribution time is also very important. If you distribute, there will be a day that we're going to pass away. Or maybe we don't pass away. We just now want to be able to gift the things that we have built and transfer it to, whether our children, whether our beneficiary, whoever it is. There's also the need to begin to think about, how do I take care of that? How much would I be able to get into the hands of the people that I want to get it to? You don't want to be the person who works and then give everything that you work for away to the government. If you don't have a plan for your estate, the government has a plan for you, Tolu Yetunji. If you don't have a plan for your estate, Tome Inyo, the government has a plan for you. Francis Ode, you have to think about all of these different 3 phases of you building wealth, Dayo Adeniyi. Because for all of these phases, we must develop the best strategy to be able to take care of them. On a final note, this is my final slide here. Since we're talking about life insurance, today is the 30th of the month, the last day of Life Insurance Awareness Day for the year 2023. Because it's the last day of Life Insurance Awareness Month, does not mean that we'll still need to talk about life insurance. I want to talk about how this instrument can build wealth for each and every one of us, Oluwafemi Odofin. And this is what I call the expression of love, caring, and then being somebody who is very wise. Life insurance is the only financial product that has feelings. Yes, you heard me right, feelings. It has emotion and deep-seated expression of love. For the vast majority of us, 9 out of every 10 of us, the greatest economic asset is the potential for us to be able to earn money as the head or the breadwinner of the family. Whether you are a man or you're a woman, it does not matter. You are a part of a family unit that can be able to take care of your economic enterprise. Look at your family as an economic enterprise. Purchasing a life insurance on the breadwinners, whether the man or the mother, makes a very good economic sense. A life insurance purchase is a sign of you being wise, being responsible, being alive to your duty, your obligation, and your responsibilities. As only this is the financial product that can perform many economic jobs, simultaneously. I love to read this letter. Everybody that I wrote life insurance policy for, I make sure that I give them a copy of this letter. It says, I am your life insurance policy. You and I have similar purpose in this world. It is your job to provide food, clothing, shelter, schooling, medicine, and other things for your loved ones. You do this while I live in my safe deposit box. I have faith and trust in you that out of your earnings will come the cost of my upkeep. At times, I may appear that I'm insignificant to you, but someday, and who knows when, you and I will change places. When you are laid to rest in your own box, I may be used to provide food, clothing, shelter, schooling, medicine, and other things that your family will continue to need, just as you are currently doing now. When your work and labor are done, that is when mine will begin. Through me, your hands can carry on for your family. Whenever you feel that the price that you are paying for my upkeep is burdensome, remember that I can do much more for you and your family than you will ever do for me. If you do your part, I will do mine. Sincerely yours, your life insurance policy. I want to say I'm really very glad that we had the chance to have this conversation, this evening. And I hope that many of you guys have gotten 1 or 2 things out of the things that we spoke about here this evening. Life insurance is not about whether we will die, we will all pass away. It is mainly because the people that we love and care about are still going to be here when we're gone. What are you going to do if something were to happen to you today? If you get sick, what is the future of the family that you're currently, leading? Thank you for taking the time to listen to us. And then this concludes our Life Insurance Awareness Month series of sessions that we've had, since the beginning of the month. I want to say on this note, have a blessed evening and enjoy the rest of your weekend. And I wish you, a very, very good rest of the year as we start the month of October tomorrow morning. Have a good night, everybody.
Thank you very much.
Good night. Thank you.
Thank you.
Thanks, Bisi. Thanks, everyone.
Yeah, thank you, Mr. Bisi.
Good night.
Thank you.
I wanted to talk
Thank
about,
you.
your options.
Thank you,
this person that
Dabo.
invited you, and then we can talk a little bit.